Welcome, guys. So, today we're going to be talking about some of the terms used in forex trading. Okay, so every particular industry or any particular space or any space in this earth at all have their terms. When you go to carpentry, they have their terms. When you go to medicine, they have their terms. Going to engineering, they have their terms. Going to aviation, they have their terms and a particular word that is special to them. Okay, they have a particular way of interacting. So that's what I mean by terms. Okay, so when we say terms, it means a particular language that we use in forex trading that is particular among traders. Okay, some set of languages or particular language that when you say it, only traders would understand that. Okay, so that is what I mean by terms used in forex trading. So there are a lot of these terms, and I'll try to go through them. The first one I would want you to know about is the bull or the long. Okay, the bull or the long. So I'm going to write it out. Okay, the bull and longs. Okay, so a bull market is a buying market. All right. A bull market is a buying market, and to long mean to buy. Okay, so in simple words, the bull market or the bulls are those that are buying the market. The bulls are those that are buying the market. And when I say long the market, I'm trying to tell you that you should also buy the market. So when I say the market is going bullish, it means that the market is buying. All right. While the opposite of it is the bears. Okay, the bears or the shorts. Okay, the bears and shorts. All right. Now, the bears are the sellers of the market. The bears are the ones selling the market. All right. When I say go short on this particular peg, probably go short on JPUSD or NZD. All I'm saying is that we should what? Short that pair. That means sell that pair. Okay. So bulls for buy, long for buy, bears for sell, short for sales, bullish for a buying market, longing means I'm buying. Okay. While the bears are the sellers. When the market is bearish, it means that the market is selling. So if I short the market, it means I'm going bearish on the market. I think you understand the dynamic now. So the next one that is important for you to know is take profit and stop loss. Okay, I believe you must have heard of this. Okay, so the take profit is the price you want your broker to take you out of the market if the market is going in your direction. Okay, we have a video on that already, explain all of that. The link to that video is going to be in the description, so you can check it out in the description for full explanation. Okay, but just for a quick explanation here, you know that when we buy the market, we expect the market to go up, and when we sell the market, we expect the market to go down. So when we buy the market, we'll probably have a target where we want the market to get to. So if we are buying this market here now, we probably wanted the market to get to this place. Okay, or we knew that the market will get to this place. We can set our take profit at this price. Okay, this 1.32290. So that when the market gets to this price, our broker will stop us out in profit because we're right about the market, we're right about the prediction. Because we said buy, because we bought when we expected the market to go up, and the market actually went up, so we're going to be in profit. Okay, so our take profit is the price at which we want our broker to take us out of the market. While the opposite of it is the stop loss, and this stop loss, this is used when the market is going against us. Okay, so when we place the trade here to buy, I'll put our take profit here, meaning if the market goes in our favor, our broker is stop out of the trade in profit there. Okay, now if it happens that sometimes you could place a trade and it might not be online to monitor and watch your trade, you can also place a stop loss. Okay, where you tell your broker that, okay, since I said buy, if this market refuse to buy and start coming downward, stop me out at this point. Okay, so stop me out in a loss at this point. So that's what stop loss is. So we'll tell our broker to stop us out of the trade if the trade is not going in our direction. That is stop loss. So it's the opposite of what? Take profit. Okay, so if we're selling also on the other hand, and we said we wanted the market to get to this point, and the market actually got to this point, this would have been our TP for sell. Okay, this would have been our TP for sell. Why? Around here would probably be our stop loss for the sell. Okay, so for buying, our TP is always above our entry price. Okay, while for selling, our TP is always below our entry price. Okay, so you understand it now. So that is it in a nutshell. But if you want the full explanation of that, you could go to the link in the description to watch it. Okay, you can go to the link in the description to get clarified on it, and you also learn how to set the stop loss and take profit there. Okay, so the next thing that's important that you should know is swap. Okay, now swap, this is something that you are going to see when you probably place your trade. Okay, let's say I buy this market now. Now swap is something that your brokers charge you when you place your trade or when you hold your trade overnight. So let me buy this market. Okay, just quickly. Okay, so if I click on the trade, you're going to see a column for swap. Okay, you can see a column for swap. You can see it, and this is where it's going to be written. Okay, so if I hold this trade overnight, my broker is going to charge me for a swap. So the swap is not fixed; it's dependent on the broker you are using. All right, so you mostly see taxes, and I've not actually seen where they charge for taxes here. And you could see commission. I believe you want to know what commission is by hearing the word. Okay, some traders will charge you commission for opening the trade for you, why some won't. Okay, so that is for swap. All right, so if we could go back, I want to close this trade now. Okay, but just to show you something quickly, this is where you put your take profit and this is where you put your stop loss. But I don't want to go into that today. This way you modify your lot size. Okay, but I don't want to go into that today. There's a full video for that already, so you can go check it out. Okay. All right, so let me close this trade. This is how you close a trade. Okay, so when you swipe, you're going to see this, all these buttons. Just click on this good sign. Okay, and when you click on it, you're going to see close with loss. Depending on if you're in loss right now or in profit, then you click on it and your trade will be closed. All right, so that is that for swap. All right, now another thing again is spread. And this is important because sometimes the spread of a market might be too much for you. Okay. And in a simple definition, I could define spread as difference between a forex broker's sell rate and the buy rate when exchanging or trading currency. Okay. It's the difference between the broker's sell rate and the buy rate when exchanging the currency. Okay, because when you place a trade, okay, let's go to a lower time frame so that we can see this. When you place a trade, let's say you are placing a buy trade. What I'm saying is that your broker should buy for you. Okay, but for you to buy, someone else has to sell. Okay, for you to buy, someone else has to sell. So the difference between your buy price and the price in which you were sold to is the spread. Okay, sometimes we define spread as the difference between the ask price, which is the buying price, and the bid price, which is the sell price. Okay, so if I zoom into this 1 minute chart, you can see the distance, okay, between these two. Okay, the chart is moving, so it's going to be moving. You can see the distance between this red line and the blue line. Okay, the total pips between these two lines, or the pips that make up this distance, is the spread. Okay, but you don't have to calculate it from here. Okay, I'm going to show you how you see the spread before placing the trade. But this is the whole idea. Okay, so if I sold here now, my trade is not going to be in profit until this red line comes down to pass my sell price. Anytime I enter a trade in the forex market, I'm always going to be in a loss. And that loss is due to spread. Okay, so let's keep looking at this market and we'll see if it's going to come down. So until this red line comes to pass this my sell price, I won't be in profit. Okay, so that is the reason. That is what spread is for. Okay, so the difference between this red line, which is the ask price, and the bid price, is known as the spread. Let me show you where you can see the spread for any particular market before you even start trading. Okay, so click on this column. Okay, go to your quotes. Okay, and if you look well, you're going to be seeing each of this market and their spread. Okay, you can see JP USD is 26, USD JPY is 26, Euro GBP is 26, Euro USD is 25, and then the USD is 25. You see, we are going to see each of the spread here. So if I pick any market right now and I place a trade on them, I'm going to be negative on their spread first. Okay, so if I pick JP USD right now and it's okay, let me buy or sell JP USD. Look at the spread. The spread for JP USD is 25. So if I open the chart for this pair, chart for it, and either buy or sell it, I'm going to be in a negative of what? You can see negative of 0.26, and the reason for that is because I'm using a mini lot for this because I don't want to use a standard lot because of my account. But you see it. Okay, you saw even open the trade, you saw negative 0.26, and that 26 was because of what? The spread. That initial loss is because of the spread, the difference between the ask price and the bid price. Okay, in this situation, if I'm saying the price I sold the market and the price someone bought it from me, or the price my broker bought it from me. You get what I'm saying? Okay, so that is spread. Now, so you can see your balance and you can see your equity. All right. Your balance is the amount you have in your trading account. As you can see right now, I'm seeing 317. Okay. Why your equity, all right, is your balance minus the floating loss or profit. Okay, when I mean floating loss or profit, I'm talking of these ones you are seeing here. Okay, so it's my balance, my equity is my balance minus the total profit or loss that I'm on. So that's why the equity right now is moving, is changing, because everything here is also changing. Okay, everything there is also changing. All right, so if this place probably increase, my equity will increase. Okay, so my balance is the amount I have for my trading account. Why my equity is the amount. My equity is my balance minus my floating profit or loss. Okay, I believe you already know that. So another thing that might be important to you is the margin. Okay, you can see the margin here. Okay, and you can see 5.75. So a margin actually is a part of a person's account that is set aside for trading. Okay, it's a part of a person's account that is set aside for you to be able to trade. Now, when your margin is low, you are not going to be able to trade any more position or to add any more position. So the more the margin, the more trade position you can open. Okay, so margin kind of grants you leverage to open more trades. So I'm going to talk about that. I'm going to talk about leverage also. When you place a trade, your margin is going to reduce. Okay, and that is dependent on the broker you're using on. So your margin is kind of like give you leverage to trade. When your margin is really, really low, you can add more positions. Okay, so you could try that out for yourself and see. Okay, so when your margin is low, you can add much positions. Okay, but then the higher the margin, the more position you can add. All right, so the next thing we're going to talk about is leverage. Okay, and in a nutshell, because there's a video about leverage already, which you are going to understand when you talk about pips and lot sizing, which you are going to understand when you watch a video on pips and lot sizing, and the link for that video will be in the description also. But in the simple word, leverage in trading basically means borrowed fund. It is the fund borrowed from your broker with the purpose of trading with a bigger lot size or opening larger positions. Okay, so by borrowing money from your broker, you are able to trade with bigger lots. Okay, so the leverage you use actually determines your buying power. Okay, it determines your trading power. Okay, the major thing is that the more your leverage, the more trade positions you can open, and the more the lot size you can use. Okay, and I can't go into the full detail of explaining what leverage is all about right now in this video, but there's a link in the description for you to watch a full video concerning leverage. All right, so these are the major terms that you might come across in trading. Okay, I will speak about lot size also. Okay, lot size is the amount you use to enter a trade. Okay, and this also have been explained in our video, and this also have been explained in detail in our video, which will be in description. It's you have been explained in our pips and lot sizing video, which is in description, so you can go to the section to watch out the full video on this concept. These are the major terms that you are going to come across in forex trading. Okay, and the more you practice, the more you understand how it all work. Okay, so don't give up, don't relent, keep on pricing, keep on watching videos. Soon it gets clearer, soon it gets easier. Okay, I don't have to cram all these terms. It's just something that as you proceed, it's just going to be there. Like you have to use it. You just know what it is. Okay, so you don't have to try to start cramming them. You are going to use it. The more you use it, the more you see it, the more you get used to it. Okay, so this is for today's video, guys. Don't forget to like and subscribe. Peace.